Today's much anticipated debate, trading blows over open banking. Who's really in your corner? I'm Ian Maloney. I'm the Senior Vice President, Head of Policy and Regulatory Affairs, the American Fintech Council. The open banking conversation has been going on for probably about a decade at this point, although some would point to, the Dodd-Frank Act as the true start of the conversation. But due to the most recent events in the industry and also some legal movements, the former of which precipitated this debate and the latter of which probably changed its dynamics quite a bit, as well as a bit of fighting maybe from online participants, Ron Shevlin and Phil Goldfeder, we at AFC thought it would be beneficial to bring this online sparring to sort of the main event ring, and recognizing that we have a bit of a unique voice in this space, that we represent banks, innovative banks, fintechs, and sort of the entirety of the ecosystem. We thought it would be good to host it. So we're lucky enough to have the debate moderated by the one and only Michele Alt, who is co-founder and managing director at Klaros Group, and she brings a wealth of experience in both bank and fintech perspectives. So without further ado, I'm going to grab some popcorn and pass it over to Michele to get this match underway.
Wow, thanks, Ian. I would say probably there are a lot of people saying, thank God there's one and only. Anyway, I'm Michele Alt, as Ian said. I'm a co-founder of the Klaros Group. By background, I'm a lawyer, OCC veteran, and a total regulatory nerd. And nerds sort of a feather flock together. So here I am with my buddies, Ron and Phil, and boys, stop fighting. No, actually keep fighting. I love it. Okay, Phil, could you introduce yourself, please?
Yes, thank you first. And thank you, Michele. You are a constant source of expertise, but also entertainment. And I can't thank you enough for your tireless friendship and partnership. And then, I want to sort of start this off and I'll introduce myself. I just want to say thank you to Ron. I mean, I have learned more from you since getting in this journey in fintech. And when I reached out to talk to you and I looked at kind of our thread of our conversation before, you've been nothing but complimentary. And so I just appreciate everything you've brought. So excited for the conversation today. Phil Goldfeder, the CEO of the American Fintech Council. As Ian said, we represent nearly 100 members and partners on both sides of the ecosystem, both innovative fintech companies and community banks. And so we bring a bit of a unique perspective. My career spans 20 years in both public and private service. I spent 15 years working for the New York City Council, the mayor of New York, in the US Senate, and then served in the state legislature myself. I spent 6 years, I transitioned to fintech, and spent 6 years at an innovative community bank. And about 3 years ago, I took over as the head of the American Fintech Council, and excited about the companies we get to represent and the topics we get to discuss every single day.
Thanks, Phil. Ron, how about you? Tell us a little bit about yourselves for the 3 people in the audience who don't know you.
I think there'd be a lot more than that. They're all here to see Phil kick my ass, but we'll see how that goes. Ron Shevlin, folks, good to thank you very much. And by the way, Phil, thanks for doing this, and thanks to all of AFC for getting this together and pulling this in such a short period of time. And I'm thrilled to be part of this. I am Chief Research Officer at Cornerstone Advisors, a consulting firm that serves predominantly the mid-sized bank and credit union market, as well as doing a lot of work with fintechs ourselves. And so, by the way, I am not here to defend J.P. Morgan Chase, just here to argue for the economics of the industry. I've been with Cornerstone for 10 years. I've been in the tech analyst world for a long time. I spent a number of years at Forrester Research and IT Group before joining Cornerstone. So that's kind of my take. And some of you may hopefully have seen the FinTech Snark Tank blog on Forbes that I write occasionally.
I love Snark Tank. Such a fun blog, and I think it's the best name of the blogs out there. Okay, guys, put your gloves together, right? This could be a clean match. Okay. So let's get started just with a little bit of background. Ian laid it out nicely. I would definitely say this whole thing dates to 2010, the Dodd-Frank Act. Remember that? 2010, guys? You know what I remember about 2010? I had dark hair and a functioning metabolism, but that was then. So what happened since 2010? Okay, in 2010, Section 1033 says the following, excuse me while I read, subject to rules prescribed by the Bureau, that's always the big subject line. A covered person shall make available to a consumer upon request information in the control or possession of the covered person concerning the consumer financial product or service that the consumer obtained from such covered person, including information related to any transaction, series of transactions, or to the account, including costs, charges, and usage data. I mean, pure poetry, right? I mean, what could possibly be left to interpretation? Well, right? Okay. The devil was in that detail, especially that subject to line. It takes too long to recount all the twists and turns between 2010 and 2025, but I would highly recommend for people who haven't read it, our friend Tom Brown at Paul Hastings has an excellent primer on this whole history. Please look at it on LinkedIn. He's got all of the gory details, but suffice it to say, it took until January of this year, suspiciously right before the inauguration, for the 1033 rules to go into effect. Just kidding about it being suspicious. Just obviously it was a last gasp of the prior leadership at that agency. Then, Phil, what happened?
And then the real debate ensued. And so first, again, I probably should have mentioned this earlier, coming from Queens in New York, Ron from Boston and Massachusetts, there'd be natural enemies, right? Yankees versus the Red Sox. But I learned that Ron is too a Yankee fan. And so we're going to start this off in an agreement. Sorry to all you Met fans and everybody else from across the country over here. To me, it's funny, Ron and I spoke a bit, and we always say from the American Fintech Council's position that clarity is key, right? Even if we disagree sometimes, understanding the rules of the road, what fintech companies, what innovators need to do is critically important to their success and their offering a better consumer product. And that is something that we have advocated for through multiple administrations. I don't want to get into the debate on, well, this was a Biden era, a Trump era. We can look at sort of, if we look backwards, just as last week, this administration sort of reversed its initial course to kind of reopen the rule and bring it back up. And I'm sure we're going to get into that. But if we're going to really oversimplify this, it's about consumer data and the consumer's ability to access that data to ensure they can get the best possible financial product for their own financial well-being and future of their financial prosperity. To me, that is where we start and end this conversation. And I know in thinking through this debate today, we were actually part of it is, well, what are we actually debating? And I know we're going to go through a few iterations of that, but to me, it's really about consumer owning their own data. The purpose of, and Michele, I think you laid it out well, as did Ian, the purpose of the open banking rule was to provide the rules of the road, right? To provide the clarity, to make it clear that the consumer owned their own data, but at the same time, to give fintech companies and aggregators the rules of the road that they need to maintain by in order to continue to be able to access that. And so that comes back to number two, which is the competition, right? Creating that competition so that consumer gets the best product. And then finally, number three, but I know this is probably where we're going to get to the core of it, it's a public policy debate about what's in the best interest of the consumer. And to me, that is where JPM and some of the biggest banks in the country really run afoul, because the debate over open banking is really about what's in the best interest of American consumers. I think you've seen that through President Trump in the last 6 months, talking about the innovation economy and enabling consumer access. To us, that is at the core of everything the American Fintech Council has always stood for, and that holds true even through the debate on open banking.
Bill, I'm glad the gloves are finally coming off a little bit. You got to it right at the end, like when you said, we're not going to get into a debate about Trump versus Biden. I was like, I think we might. And But what I really want to make clear is, who's in this debate and what are their interests and what do they care about? And so just going back a little bit to the history, right? So we're finally January 2025, the rule is effective. What happens immediately, right? The BPI challenges the rule, right? And what does the CFPB do? It sides with BPI. We live in weird times, and that is definitely because of a change in administration, right? So we have, the new leadership at the CFPB going, yeah, that was a terrible rule. Let's rescind it. Okay, well, that's weird, right? And then in kind of amazing about face, we had a change from the CFPB just Monday. Today is Thursday. So Ron, tell us what happened on Monday.
A whole couple hundred fintechs thought that everything went back to normal for them and that they could go back to complacency because the CFPB announced that it would revisit, and you can tell me and the rest of the world what an ANPR is.
Oh, I'd be happy
But
to.
basically, they said we will take a look at this. And did they specify a time frame that within 3 months or something they would have
3 weeks?
3 weeks.
3 weeks.
Weeks,
Okay.
yeah.
So let's pause here because again, we've left out an important part of the back and forth, right? So BPI challenges the rule, CFPB sides with BPI, then JPMCs did something pretty darn interesting.
Yeah.
Phil?
No, I would say, I think the key points, right, in light of recent events in the marketplace is what the CFPB specifically pointed to. Ron doesn't like that if I don't want to take credit for the CFPB's maneuver. I did join a number of our trade partners, led by our friends at FTA, but including the Crypto Council for Innovation and so many others, to sort of send a letter to the president. And we are happy to say that, they made it very, very clear that it was in light of recent events in the marketplace. We can argue sort of what JP Morgan's strategy was or wasn't when they introduced or when it came out that they were going to charge not just fees. I want to be clear that they were going to charge exorbitant, extreme fees to fintech companies to access data that didn't belong to them. And if Ron, I will, and again, I appreciate this, and everything I say, and you always have to be afraid when someone says, with all due respect. So I'm going to start that right now and say that I absolutely respect you, and I want to have this conversation. But you made a statement that sort of, to me, sort of goes to maybe the core of this, and I'd love, fintechs can go back to complacency. To me, I would argue, and I would say this about my members, but I'd say this about all responsible innovators in financial services. They are not trying, attempting in any way, shape, or form to being complacent. They're trying to understand the rules of the road, to understand how to offer consumers the best possible products, savings, lending, financial tools, so that they could survive when the biggest banks in the country are not offering those tools. JP Morgan and the biggest banks can do it. They have the finances, they have the resources to offer those tools, but they're not. And I think responsible fintech companies stepped up in the absence of those service providers. And so to me, we look at that as there's a fundamental difference between what many would consider the Wild West of fintech versus the way I think many of my members and I see it as a responsible, innovative ecosystem trying to develop the rules of the road.
Phil, a couple of comments. First of all, I was kind of making perhaps a bad joke about complacency because it wasn't really about complacency. It was really more of a, okay, good, we're making some progress on this. A couple of things. It's funny, I had a couple conversations the past couple of days going, I don't know why I'm having a debate with Phil. I think I agree with him on 99% of the things that we're talking about here. The whole fintech industry and opportunity has been created because banks and credit unions didn't fill certain gaps in the product service delivery that created this opportunity for them. There is absolutely nothing I believe more than that. I also believe that, as you would advocate and claim, that consumers own their own data. But that is not the crux of this decision, or this discussion rather. The crux of this discussion is the economics around the movement, transmission, storing, and protection of that data. Now, it's interesting, Michele, you read the description of the 1033 rule back from 2010, and it did talk about the covered person who, I believe that's banks, is the covered person, although it's kind of weird language. You lawyers always figure out how to twist those things around. Did absolutely say that they would have to make the data available to the consumer. But maybe I'm missing something here, but where did it say that they were also required to provide that data to other people who were not the consumer? Now, what this really comes down to in my mind is this is about convenience. Because the reality is that pretty much since the beginning of online banking, banks have provided consumers with the ability to download their data. You could download it to Quickens Intuit's Quicken and all of those types of programs for probably close to 25 years now. And so that's always been in place. You can download the data. What we're talking about here is the inconvenience that consumers would have in having to send their data to the fintechs that they want to work with on a daily, weekly, or monthly basis, annual basis. And that's kind of the crux of the discussion to me, is that, look, in every other aspect of our lives today, we as consumers pay for convenience. Michele, you want that big plane seat up in first class, that where you get some extra leg room and you don't have to sit right on top of your husband Conrad on the flight down there. Yeah, you got to pay for it. You want to not have to wait at the bus station or the subway to get your bus or train, and you want to get that car. No, that Uber will come. You pay for that. You pay for convenience in this economy. And the providing fintechs or any third party who wants the data that is being stored, managed, and protected from a bank it's a convenience. And it's not a fee that is based on what the cost of the service is. It's based on the value that the consumer ascribes to the convenience that they're being provided. So I disagree with Todd Baker's belief that this ought to be a cost-based, fee.
So Phil is taking notes, and I really want to hear what he has to say. But sure, I pay for first class, but there is no law that says the airlines are supposed to give me first class for free. So Phil, what do you say?
So thank you for that. I'm always fascinated with sort of this idea or the plight that, poor old JP Morgan on their chase to reach $1 trillion, right? On their chase to make more and more money, which again, I have no objection to when they're doing it by offering better services. The fintech companies that Ron sort of is referencing, to be clear, is operating on behalf of the consumer. I've been following, obviously, in preparation for this, but also just in general, in terms of how we think about open banking. I think it was JP Morgan that kind of put out or leaked a memo that talked about in the month of June, there was 1.89 billion API polls, right? And the cost of those polls, and most of the fintech companies are utilizing that data for their own benefit. That right there shows inherently that JP Morgan doesn't quite understand what's happening, right? Which is why they're not creating the system to begin with, right? The idea that a fintech company is doing multiple polls is so they can keep ensuring that the consumer's fintech company, right, has the most up-to-date information so they can make determinations how to best sort of lever up or lever down the services that are being provided. And so, I think JP Morgan is trying to oversimplify the idea that every time the consumer pushes the yes on their app, then that sends a pull. The fintech company, and I think this is the point I wanted to make, the fintech company is acting on behalf of the consumer to offer the consumer the product that they signed up for. What I think is interesting is, and I will make it clear, we don't represent the aggregators that have all been mentioned. AFC does not represent the aggregators, which I think is important to make note of, but they are the ones that made the data usable, right? Now, JP Morgan could have, you say you plowed the field. JP Morgan could have invested in that technology, could have competed. There are some who will point to the fact that they did try to, and it's not going as well as they initially thought. They tried to compete in that space, but they're not able to compete with some of the aggregators that we're all talking about. And so in the absence of that, how do you bridge the gap? Am I, Phil Goldfeder, meant to go sort of into the back end of Chase and kind of figure out what my considered, how to manually get my consumer data over? No, there is a responsible innovator who, by the way, and I don't say the word responsible lightly, a responsible innovator that recognizes the challenges of keeping that data secure. And they are doing the best to create that bridge between JP Morgan. Again, the concept of, well, who has to pay for it? This is going back to the old Don Draper line. Like, that's what the money is for, right? If someone has a Chase account, they're paying for it. And Ron, I think this is one of the debates we had online. People are paying fees. Just in the last week alone, by the way, Chase, for some people, increased their monthly fee access account from $13 to $15. Some notices were $15 to $17 to access their Chase account. Chase charges fees. No one is concerned that they're not making enough money. And so the idea that all of a sudden, somehow, that they have to pay for the integrity of the systems that they've built is just simply not true.
Hey, let's stay for a minute on the JPMC announcement or leak, that period from there to the announcement of a pending ANPR, Advanced Notice of Proposed Rulemaking. We'll get into that. But let's just assume we're in that period prior to the CFPB's about face. Who are the winners and who are the losers there? And is it as obvious as it's just, well, JPMC will make more money? What do you think, Ron?
I'm sorry, who be the winners and losers in what scenario?
In what scenario? If JPMC and other large banks just start, charging these fees, is it just that, that the banks earn more fee income? Or, for example, does that kind of take us back to 2010, where, the big players in the data were the CRAs, right? With their sort of flawed reporting and data gathering, as an example. Who might benefit in this scenario other than just the banks?
I think the big loser in this, and this really pains me to say this, but I got to be totally honest and forthcoming on it. I think we see one really big loser in that scenario, and that's MX. And I say that because a couple of reasons. And first of all, I do want to go back to a comment you made, Phil, when you said that JP Morgan didn't know something. I think it'd be very wrong to ever accuse JP Morgan Chase and Jamie Dimon in particular of not knowing what they're talking about. That's I
have to agree with that, Ron, for sure.
They're very measured, and if they put something out, they know what they're doing. I don't think you should ever accuse them of not knowing what they're doing. And to the point of the release of the billion hits and look, us insiders know how to parse that out. But to the media and the general public, it looks like, oh my gosh, look at this, billions and billions of hits, and they're getting slammed. So yeah, we know, and John Pitts knows, that it doesn't have to be a billion. It could really be $500 million with smarter and better technology. But remember that the charges and the fees that JP Morgan is proposing to levy are not directly on the fintechs, nor are they directly on the consumer. And so the real focus on this is on the aggregators. Now, I pick out MX in particular for a couple reasons. Number one, because I would not be surprised to find out, and I don't know how I'd ever would find out, that JP Morgan Chase already has some sort of agreement or deal, rev share, with Plaid. I mean, JP Morgan Chase is smart. For years, when it was all screen scraping, they would change the positioning of the data on their screens every night to foil Yodlee and MX and Plaid, and JP Morgan Chase basically forced Plaid to acquire Quovo and Cognito and was it Flannel, and then but they've done a great job, and that's why I don't think Plaid is the one that ultimately gets hurt. They may get hit. I think this could simply be a way for JP Morgan Chase to renegotiate any deal they might already have with Plaid, and it was perfect timing to do it. Sorry, Michele, because of the politics, because they never would have done this or announced this during the Biden administration. So good timing for doing it. I also don't think that Chase, because of its relationship with MasterCard, is going to sock it on Finicity. So it's left with MX. And I don't think the fintechs ultimately get hurt by this because the aggregators are going to have a tough time passing on the fees to the fintechs. You look at the margins that Plaid has, they're pretty high. They can absorb some of this price hit. And they're also in pretty good position because they're offering a lot of different value-added products and services to the fintechs today around KYB, KYC, AML, payment process, the stuff that they're doing. So I don't think we get a lot of losers in this. And last comment I want to make, Phil, back to your point about JP Morgan Chase charging their consumers for fees today. They absolutely do, but they don't cover data transmission. And by the way, this is not nobody's, and first two things. Number one, quickly, I'll finish this point. Number one, nobody is selling consumer data here. Nobody is saying that the consumer doesn't own their own data. But this is not about the data. It is about the verification, validation, and veracity of that data. Because it would be simple for consumers to just download their data and send it off to the fintechs. Now, if that were the case for loan applications, would the fintechs accept that? No, of course not, because who knows how they would have tampered with it. So what the fintechs here are paying for is not consumer data, and that's not what's being sold. What's being sold is the trust, the validation, verification, and veracity of the data. It's almost as if Chase is providing notary services to guarantee that the data is correct.
I mean, I guess my question on that, and one, there's a number of points that you raised. Is who is making the determination what Chase is actually getting paid for, and then ultimately what becomes revenue? I want to be clear about something, right? That people talk about the consumer trust in traditional financial institutions. That trust is not because something that JP Morgan did or the big banks have done. That trust comes from the faith and backing of the federal government, right? In the form of deposit insurance, in the form of the regulatory structure, right? So Chase and JP Morgan, and I don't want to, again, I know we're singling them out, but I think it's sort of the largest banks are right now incentivized to bigger moats, create larger walls, and prevent competition from entering. And this is, I think, something interesting is, within the aggregator space, there is inherent competition. You mentioned Plaid, you mentioned MX. Just yesterday, a company called Solo introduced a consortium of community innovative banks to create their own system. I think if you're an aggregator, right, then you have to be worried about the next innovation in that space, right? You have to be worried about what's AI going to do in my space and how am I going to continue innovating? That is something that they have to inherently deal with every single day. JP Morgan does not have to deal with that, right? They don't have to deal with it because they are the only ones that have access to the data of those consumers. And they're gaining that access because they do have the faith of the benefit of the federal government and the backing of the federal government. And that to me is sort of an inherent unlevel playing field. And the way we look at it is, I often say this, and some people agree, and I've had my, debate with Jonah Crane about the concept of, fintech democratizing financial services. But we fundamentally do agree in that, we're trying to create a level playing field. And I think where you and I, obviously, we agree is that clarity is key, right? Provide the clarity, we all know what to do and what the rules are. But this is a case where JP Morgan is not just offering a fee. And I do want to clarify this one other point. And I don't know if we lost Michele.
I hope not, because this is
yeah. I would say is that it's simply an unfair playing field where some people have to compete and some people don't have to compete. And some people are able to sort of box out others using, like I said, the benefits of sort of the government protection, while some are forced into the West. And this was the point I wanted to make, was it's not just about a fee. It was about an excessive fee, right? The fees that have been reported, and I haven't seen any internal documents, but as it was reported, I believe first by Bloomberg, the fees proposed go far beyond the cost involved with providing the data access, which to me signals a move not to work together with aggregators, but to sort of put them out of business.
Yeah, a couple of reactions. And boy, do I
Please.
hope we didn't lose Michele. She's down in Mexico, so maybe there's something there connection-wise. But a couple of responses to that, Phil. First of all, I don't know exactly what the fees are. I have to go by what that report was.
Same.
And again, this to me, and not to make this political, but does remind me of Trump's tariff approach, which is let's go far out there and negotiate in. And so, yes, they may have established those fees, but they do seem to be willing, Chase, that is, there's Michele, good, to negotiate that with various players. Now, they also established different levels of fees based on the type of product, I think payments. And so clearly they're trying to protect their payments business more so than others. I do want to make a point, though, about your comment that what they're trying to do is build a moat and protect that, which, if you ask me, is what every one of your constituents is trying to do. And in fact, almost every VC wants to know from the companies that they invest in, what's your moat? What's the moat that you're building? So I don't think we can criticize Chase or anybody for attempting to build a moat. That's what the competitive capitalist environment is all about, is creating competitive advantage. And the reason that the fintechs exist is because there have been so many holes in the moats that the banks have built. So you can't criticize them for doing that. Michele, welcome back. I hope you didn't
welcome
miss
back,
too much
Michele. No, and Ron, I appreciate that very, very much, and I understand what you're saying in terms of the moat, except for the fact that there's an inherent there's a disadvantage in that. Oh, I think we lost her again. There's an unfair advantage from the biggest banks because only they control the data that comes through their system versus every other VC recognizes, right? And I look at all my members, right? And many of them compete with each other, and yet they find ways to work together and figure out sort of the new ways, because ultimately it's about serving the consumer. This is what fascinates me, because Ron, I think I understand what you're saying. JP Morgan can replicate and build fintech, solutions that provide access to consumers. I think about, and again, I without mentioning company, there are companies where you can open brokerage accounts, right, that have become very popular that consumers use. Chase can offer the same thing. As a matter of fact, Chase does have one. It's just not very good, right? And so consumers don't use it. And so a consumer that does want to, sort of use Chase is sort of making it very, very clear. They don't care about that retail consumer. They care about him because they want his deposits or their deposits, but they don't care about offering him better services. And that's where the fintech companies and the VCs, as you mentioned, think there are opportunities. The solution is that Chase should offer more of those products. And by the way, and maybe I'm getting myself in trouble, let them build it. They make record earnings, record profits. Let them build a better mousetrap. They just refuse to. And instead of doing that, instead of enabling the ecosystem, they threaten it with sort of exorbitant fee structures, similar sometimes the way they're accused of doing that to their own consumers as well.
Okay, jumping back in, sorry, there was several snafus down in Mexico today. Let's talk about several points that have been hinted at. First, is this just a negotiating strategy? Is this just sort of like a Trump tariff negotiation? You start by saying it's not going to cost you thousands what it cost you before, and to drive a deal? That's my first question. Thoughts?
That might have been the point at which you dropped out, Michele, because that was a point I made, that I do think
Okay.
that this could very well be simply a negotiating ploy on the part of JP Morgan Chase.
If I
Yeah,
can, by the way, on that, just on that point alone, again, think about sort of the consumer fear, right? Like the idea that, right, there's a thought that services and tools and resources that consumers have become accustomed to using are now in fear of losing those same services that they think that they know are propelling their financial future. Again, we shouldn't be playing with consumers that way. I think JP Morgan, sort of, again, and I think to Ron, your point earlier, there's no mistakes, right? Whether it works out the way they hope it will, or that it goes the way they hope it will, I don't know, always works out. But I agree with you that, I think they're playing a game. And to us, and to sort of innovative fintech companies who are trying to provide those services, there's a lot of fear in the market today, and that's just shouldn't happen in financial services.
I wouldn't
let's
call it a
say-
game, Bill.
Yeah,
It's
okay.
not a game that they're playing. They are protecting their shareholders' interests, optimizing their shareholder interests, which is what every company that is listening in on this in this discussion is trying to do. So we can't criticize them for that. I don't call it a game.
Okay. Two more questions. In terms of fear out there, who is afraid and what are they afraid of? Do consumers really, for example, the actual consumers, are they following this debate? I mean, not the one we're having today, but this issue in general. It seems a little obscure, actually, I would think.
I would say, I mean, look, we talk about this all the time at the American Fintech Council, right? Consumer education is critical to ensure they're picking and choosing the right products that meet their financial needs in that moment. And so I think there are a percentage of consumers who have gotten the notice in the last few days that their checking account fees are going up, or that, sort of financial, sort of there's been this unrest in the financial technology ecosystem. I think ultimately it's, like I said, this goes back, and you could sort of play this thread through multiple administrations. You've seen bipartisan sort of agreement that a solid, fair, open banking system creates competition, creates opportunities for banks and for innovators, and then creates the ability for them to each fight to provide the best product. Right now, if the biggest banks in the country got their way, they can continue to offer subpar products to consumers without any fear or any competition. And that, I think, is the inherent difference, is that every single day, fintech companies that I represent have to worry about their left flank, right? And I don't mean left as in politics, but the saying left flank. They have to protect their competitive advantage. So I agree with you, Ron, but they do that by providing a better customer experience. JP Morgan, PNC, others who are thinking about this, they're protecting their left flank by removing, sort of optionality in their offerings and putting up, larger walls and preventative measures to enable consumers to access what it's theirs.
But Phil,
Ron?
if that were the case, then a couple of things. Number one, if this were such a big problem, then Chime wouldn't have 15, 20, or whatever million number of customers they have. Current wouldn't have the number of customers it has. Well, all of the neobanks that have seen any level of success would not have it. It was Alex Rampel, am I saying his name well? Who said that, banks don't have customers, they have hostages. First of all, that was an incredibly disgusting analogy, offensive to anybody who actually has ever been held hostage by somebody. But it's simply not true, not the case. We've seen plenty of movement switching. A lot of that is additional accounts. But, Chime's got a pretty good percentage of its customers who are their primary bank customers, and they've moved. It's so, that's the beauty of our financial system here, Phil, is you don't like it, you can move. They are not hostages. And this success of many of your members over the past 10 years is proof that they're not hostage. The other problem I've got with your argument is that you seem to have tied some recent increase in the fees to the Chase announcement of charging, which makes no sense to me, because why would the banks raise their fees if they thought that they were going to be able to generate revenue by charging the aggregators? And ultimately, I think the real fear here is among the fintechs who are customers of the aggregators, who are afraid these costs are going to get passed down to them and they're in a situation where their business model can't handle an additional fee, which is kind of funny to me because, seems to me that the fintechs are the only companies in this country and perhaps the world who don't have to pay for the raw materials to their business. They're basically getting their raw materials for free. Now, you can say, yes, it's the consumer giving it to them, but it's not the consumer giving it to them. It's the consumer requiring and forcing the holder of the data to give it to them. As I said before, if that's the case, then download your data and send it off to the fintechs and see how well that works. And that's not going to work very well. So I think who's fearful here? It's the fintechs. And I don't think the consumers have any clue about any of this because any price increase they see, they think is a result of either the tariffs or the general inflation that we've seen in the past couple of years. They're not attributing any increase in fees to JP Morgan Chase announcing that they're charging. They're not even in place yet.
Ron, could I jump in? Now, in fairness, it's not like Phil's used the word hostage, but it is true, though, that it is not very easy to move an account. There's a reason people tend to not move their accounts around. It's a hassle, right? And there's a reason people don't download their data and upload it, elsewhere. That's a hassle and it's clunky. And these sort of clunky, difficult to interact with systems are why that on the bank side are why fintech really took hold, right?
Sorry.
No, just it's not as easy as just kind of saying, well, if they don't like it, they can move. It's hard to move and it's hard to get this data across. And I think
Ron,
ten thirty three was to try.
No, and actually it's simple as anything. And there's a difference here that we need to clarify. There's a difference between moving money and moving data. And reality is, and guys, I'm happy to share the consumer data with you. The average millennial has 3 checking accounts. The Gen Zers are going to get there, and even the Gen Xers are catching up. And so, and I actually got a couple of presentations next week to do where I'm going to be arguing that direct deposit ain't that important anymore because you do your direct deposit with JP Morgan Chase, and thanks to ACH, you move the data out to Chime or wherever else you're doing business with.
But by the right, Ron, but that inherently is the problem, right? And you're 100% right. I don't think about myself, and and our friend John Pitts loves to mock me for this example, but I use it often because I think it's critically important to understand the generational financial services gap, right? My dad or my mom write a check to my daughter, right, for her birthday. She gives it to me so I can then deposit it in her multiple apps, right? And so we think about who the end consumer is, right? Maybe there's a strategy for, like I'm tied into a big bank because I've been using it for a long time. The future of financial services is not in traditional finance, right? There is, and here's I think the point that's missing. Chase could provide the service. Chase can build the aggregated service. Again, you're seeing it. There was an announcement yesterday that Chase partnered with a fintech. You know what the challenge with that is? It cuts out everybody except for the biggest players in the ecosystem, right? And then, without getting into the details of the announcement that was made yesterday, Chase integrated directly with a fintech company, right? And cut out the aggregators, which shows and demonstrates they can do it. The challenge is that most of the fintech ecosystem, that's not going to be available for, right? Chase gets to pick, JP Morgan gets to pick the winners and losers and who gets to offer services and who doesn't. And that to me is anti-capitalism, it's anti-competitive, and it's everything that this country doesn't stand for. And I know we don't want to talk about politics, but it goes against everything that the Trump administration has talked about in their innovation agenda, which is ultimately why they reversed course this week on this decision to reopen the open banking rule. The open banking rule creates a fair playing field. It creates an opportunity to understand the nuances of the regulatory structures that aggregators would need to put in place, that fintech companies. I represent an industry that is built on bank fintech partnerships, right? Like the idea that you have to find ways to work together in the interest of providing consumer good. JP Morgan has not made the indication that their focus is on the consumer. It's around their own bottom line. And I understand that, and they're allowed to. It doesn't make it right. They can, it doesn't mean they should.
Phil,
Okay.
blaming JP Morgan Chase for not being focused on the consumer is just not a valid argument. There's you can't run a business for any stretch of time if you're not satisfying your customers. Now, they may not want you as a customer, even though you chose them as a
Not anymore,
customer.
Ron. Not anymore.
That's for sure. And so you can't make this connection. They don't care about the customer, and yet they're making trillions of dollars. That's just not the way the system works. You've got to have some satisfaction for that. Now, to your point about the politics, I think I kind of agree with you, which is why I found it interesting that the Wall Street Journal today reported that guess who's talking now? Trump and Diamond. Isn't that interesting after not doing it? So yes, not only were you successful in getting Trump's attention, but Jamie Dimon's, getting back in there. And by the way, JP Morgan Chase, correct me if I'm wrong, I do believe that they actually have invested in Plaid. And of course, they helped to establish Akoya. Now, my take is
Well,
that
let's talk about Akoya. I was hoping we'd bring up, who is Akoya a winner in this?
um, I don't think so. From best I can really see here is that Akoya is spending more of its focus on the wealth management trade, the brokerage side of the coin versus the banking. And I think that that might be one reason why Jamie Dimon just did what he did here and said, "Screw it, I'm not getting the stuff I want out of Akoya to do it. They're not building any traction." And we're going to go focus on, the existing aggregators and bust this up. And again, as I said before, not Finicity because that would impact their MasterCard relationship, and not really Plaid either because if they are an investor, then they have a vested interest. And number two, as I said before, not surprised, wouldn't I be surprised to find they actually already have a deal in place with them that, they may just be looking to get better economics out of.
So,
Ron, sorry.
okay.
Go ahead, Michele.
Well, I'll give you the last word on that topic, and then I want to make sure we have a few minutes to talk about the ANPR and what to expect. I have some thoughts there, but
Yeah.
back to you.
So I would agree. I think I agree with what Ron said related to Akoya. I think sort of there's sort of been a move away from that. But I want to go back to something I mentioned maybe quickly earlier, right? Is that aggregators need to think about sort of their competition, right? And I wouldn't support the biggest aggregators as much as I don't want to support the biggest banks, right? I look at it as democratizing the ecosystem and creating opportunities for everybody to play in this space. And I use the word play, very carefully, but to operate in this space to create better customer service. Again, there was an announcement and there was an article by Penny Crossman in American Banker yesterday about bank tech ventures investing in a company called Solo that's building a consortium of innovative community banks to create their own network. By the way, Ron, this may become, and that takes off, right? And it becomes kind of the new quote unquote aggregator, right, of consumer data. And so I think, sort of the aggregators have to be worried about that ecosystem. The challenge I have here is that right now, too much of the ability to pick winners and losers is in the hands of the biggest banks, the biggest players. And for us, we think that, again, consumers need to know that the products they're getting are the best possible products, not just the ones that the financial institutions are making the most money on.
Before you go to the NPR, Michele, I do want to address this because I am in a lot of agreement with Phil on this point to a certain extent. And I do think that Solo, and I love what they're doing, and it should be a consortium of not just the banks, but of the fintechs as well. And it provides a mechanism for not just the data sharing, but for sharing in the economics of the system. And that's the problem we have now is that it is not equitable from an economics perspective, whether you like JP Morgan Chase or not, or whether they're a trillion gazillion dollar company, that doesn't matter. It's funny that you referred to and alluded to the unfair playing field. Quick story. I was down in Cape Cod a couple of years ago. My family and I were biking. We went out one way, we came back the other, and I came back going, damn it, it's uphill in both directions. And it was killer. And realized that no matter what side of the field you're on, in almost every case, you feel like you're at the downside. So don't give me the unfair playing field because there's arguments on either side of that. But here's the thing, and this is why, and I mentioned this in our pre-call too, is that to me, JP Morgan Chase is not the villain here. Neither are the aggregators. They are not the villains, although there's plenty of accusations that they are making, unfair economic rents off of this. To me, the villain in this is the government and the regulators who are always in reactive mode to this and then approach things with a punitive type of approach that go, oh, well, we've got to harm JP Morgan Chase because I don't like big banks and they need to be torn apart. And you look at Solo, and I love what they're doing, and I think it's a model for where the industry needs to move to. But the regulations don't enable this, support that. They just take a punitive approach on who should pay and who should be able to generate revenue or not. And that's my big beef.
I just to clarify with everybody that we agreed upon, right? Clarity is king, right? Understanding the rules of the road are critical to making the right financial services decisions for your company, by the way, and for consumers, right? To understand who you're engaging with and how they're keeping your information and your financial wellness safe.
All right, let's talk about clarity, hoped for clarity. Okay, for those who don't mind being bored a little bit while I explain the Administrative Procedure Act on rulemaking, an ANPR, an Advance Notice of Proposed Rulemaking, is what an agency uses in advance of a proposed rule to solicit input on general ideas and concepts for a rule. So it's not that big of a lift to come out with sort of that ask in a few weeks, right? What the question should be is, when will we see a final rule? Now, I don't think it's going to take another 15 years. And I know the agencies like to move quickly these days, which is great, but it's going to take a little while and the debate will be fierce. And it is incumbent upon those who are interested to comment on both the ANPR and the eventual proposal. It is possible, based on the NPR, that the Bureau could go out with a interim final to speed things up. But what I suspect, and I'd like your take on it, both Phil and Ron, is ultimately maybe BPI and JPMC get what they want with this move, which is a renewed chance to influence the 1033 rules. Thoughts?
I'll start, Ron. I don't, again, anybody who knows the American Fintech Council, that this is Ian Maloney's area of expertise, and he is the one who sort of manages this part of what we do. It's, I agree with you. I think we can get the ANPR out quickly. The question is how do you actually sort of go through the process? At our best estimate, we talked about this a bit yesterday and the day before, since the announcement, at best you come up with a 12, 18-month time frame before you have a new
I think
final
that's
rule.
fair.
And I think the question is going to be then going back to the original debate, right? I don't think we're going to settle the debate about can you charge, can you not charge. I think a lot of the areas we're going to come back to where we started from that we're going to agree on. You're going to create a whole new opportunity to have essentially the same debate happen again. And then, by the way, without forecasting too much, probably another lawsuit, right? On what is found there,
Oh, for
depending
sure.
on which way they go. So
I think we'll be fighting about this for quite some time. All right, should we give the last word to Ron? I think he was pretty brave to come into the ring here and has acquitted himself, I think, quite impressively. But Ron, you get the last word.
Thank you for that. So my last word is really thank you to Phil and the AFC for pulling this together, and thank you, Phil, for making this a hospital civil discussion and debate. As I said before, I thought we were going to really agree on a lot more things. Last thing I'd say, though, to your point about the ANPR, Michele, is that I don't think we're going to get a lot of resolution on this, but what I would hope that it would get a little more foresight about where things are going from a technology perspective. I mean, take a look at some of the stuff Richard Crone has been writing about agentic AI and things like that. And if Jamie Dimon's worried about the billions of hits he's got already, that's only going to triple and quadruple when we start to see the emergence of this. So what are the economics of that? What are the impact? What are the, there's just so much that's coming down the pike from a technology perspective. And my beef about the government has always been the regulators are always seem to be years behind where the industry really is from a tech perspective.
Fair enough. All right. Well, thanks, fellas, for letting me jump into this fracas. It was pretty mild, I would say, but very spirited and interesting. Sorry about the tech snafus. That's just the way you roll on live events.
Well, it's
Phil?
because Jamie Dimon owns the ISP that serves you, and you got pulled out from that. I'm
I
pretty
know.
sure.
Yeah,
It wasn't me.
yeah, like Jamie Dimon cares about that much about this. I forgot. So some of my questions today, I had asked my partners at Klaros, any suggested questions. I forgot the first one, which was, how did a nice girl like me wind up with you two schlumps? So guess who that was from? Okay, Phil, you wrap it.
Thank you guys so much. Again, Ron, appreciate everything. Michele, thank you for doing this. I look forward to the next one. Ron, you're committing. We're doing this again, maybe in person next time. So we're going to talk about that later.